NIO is a pioneer in China's premium electric vehicle market. They design and sell premium electric vehicles. They also drive innovations in technologies such as autonomous driving and artificial intelligence. They aim to improve the user experience by cutting down the charging time of electric vehicles from hours to minutes by implementing a successful battery swapping technology. It must be said that although this does suggest an improved customer experience, it has economic and manufacturing disadvantages to NIO. NIO believes it is more than just an automobile and EV company, as they also provide customers with an ecosystem of services and products such as NIO House for social benefits, leveraging on their trendy brand image in China currently, which is a very powerful intangible asset to possess. As for the stock, well, it's been one of the highest flyers of the past year, providing investors with over a 10x in just 12 short months. However, this really masks the struggle that NIO had to endure over the course of 2020. The company was flirting with the possibility of bankruptcy during the coronavirus pandemic, as the company was bleeding cash. They received some much needed help from the Chinese government in the form of a $1 billion investment that should be seen more as a bailout, and of course, the $1 billion investment came with a catch. As part of the deal, NIO transferred core assets and businesses in China into a new company and handed over 24% of that entity to the new investors, being the government. NIO now owns 75% of that operating company called NIO China and will inject 60% of the government's investment into that company, meaning that your investment into the holding or shell company listed on the New York Stock Exchange holds 24% less value versus before the $1 billion investment. Not a great trade-off for investors, but it needed to stay afloat somehow. Despite all of this, NIO rose to become the fourth most valuable automaker in the world, bigger than the likes of Daimler and GM. Of course, it did almost go under, and it had to sell a quarter of its operating company to the government in exchange for just 1% of its current market value. But it is an EV company, so, it's more than justified. Right, a quick look into NIO's current vehicles. Got the EP9, the EC6, the ES6 and the EP8. The EP9 was its first and is an electric supercar, or looks that way. That looks very unique, and the others are SUVs which actually look very good, and you can see where some of the premium aspect of NIO is coming from. They do look like premium cars on the face of it. They do have a lot of upcoming models and concept models that will hopefully start production in the near future as well, and this is a positive to look out for soon. If I switch to a more bullish outlook on NIO, China is by far the largest EV market in the world and will continue to be, surpassing Europe and US by quite some way in terms of cumulative sales of EVs in the region. As we know and have covered in our Alibaba analysis before, China offers a huge opportunity to any company that is set to thrive in the Chinese economy, with tailwinds such as the 9% annual economic growth and the mass migration to digital and cleaner energy sources. NIO will no doubt be a big beneficiary of all of this. China's EV sales are set to quadruple from 2020 to 2025, which would be quite something, and the total sales are expected to reach almost 6 million units per year. With NIO claiming a 3% market share, this means their cut of the sales could be around 180,000 annually. However, if they can prove dominant in the China EV market, that number could actually improve quite drastically. Although they have a few notable rivals, their main focus and investors' main focus should be Tesla, who entered the Chinese market in 2019. Tesla already have better sales numbers than NIO, but NIO feel they offer unique advantages to the customer that Tesla cannot compete with. For instance, the majority of their cars are cheaper to buy, but possess almost the same level of luxury. They adopt a battery swapping technology which improves charging time, therefore customer experience. They offer ancillary services and products to NIO users, such as NIO House. NIO also outsource manufacturing to a company called JAC, and they only design the vehicles and manufacture the electric drivetrain. So whilst this technically will make NIO a more asset-light business than Tesla, it's uncertain whether it really makes NIO the superior business in China, as Tesla seems to have complete control in its manufacturing and production, whereas NIO could suffer from external factors that are out of their control. NIO's founder and CEO is Chinese entrepreneur William Li, who is somewhat of a serial entrepreneur. He has started over 40 companies in the internet and auto industries, And the reason why you haven't heard of any of them is because most of them went bankrupt or were dissolved. Something we should keep in mind, as his most successful venture, NIO, almost followed suit this year. This isn't to say that William Lee is a bad entrepreneur, not at all, he seems far from it, but it does suggest he is very much a risk taker, or at least bad at mitigating and managing risks within his companies, which is one thing I never like to see in a CEO of a company that I own. So I think we've covered a lot of the headwinds and tailwinds that NIO has. What I'd like to do now is dive into the financials and fundamental outlook to see if NIO could potentially be a good investment from here. And on that note, I just want to make a point that however much hype exists around a company and its future, as well as the vast amount of apparent intangible value that exists within such companies, there needs to be a way of producing a financial output that allows us to measure the value of that investment. If there isn't, then generally it shouldn't even be accounted for. A lot of the time there is a way in which you can turn hype or intangible values into real financial outputs. However, most people don't bother, and that's where investing and calculated decision making differs completely from speculation. For instance, with NIO, we're going to use the fact that China are pushing for EV sales to make up 20 to 25% of total new car sales in 2025. This would mean if they can pull it off, EV sales will quadruple to 6 million units, like we said, and this seems a very big ambition but could well happen. Keep this in mind as we're going to use this to calculate an expected 2025 revenue number. Just scanning over the financials, you can see this doesn't look like a healthy business or balance sheet for that matter. When you drill down into the right areas, you can see that they've actually managed to burn nearly $4 billion in just under 3 years from the operating business. Shares outstanding have 5x, and they have accumulated a deficit of 7.4 billion, which is essentially an accumulation of lost money that is accounted for on the balance sheet. Not very good to see, especially when it's as high as 7.4 billion. Also got debt as high as 1 billion, so they do owe a lot of money. And you could see this all as essentially owed money outwards of the company, so almost 8.4 billion in total deficit. And this is not something I like to see. When you do see it, you should act with caution and really think deeply about how the company is going to pay it all back or possibly get out of the deficit. I'll give you a hint, considering they're losing about $1 billion per year, and it doesn't look like that's going to change anytime soon. They will not be able to then pay it back through cash from operations, meaning the only other option would be to raise more debt, which can spiral out of control, or dilute the current shareholders by issuing new shares to the creditors or raising more money through share issuance. This capital raising is not used to reinvest back into the business, but rather to just allow for the company to survive, and essentially it disappears into thin air. So what happens when they actually need to reinvest money into the business to grow, but they don't have enough cash from operations? You guessed it, raise more money by issuing more shares or taking on more debt. And they will have to do this at some point, as growth doesn't come for free, especially when you're in the auto manufacturing or electrical battery manufacturing business. You cannot just grow without spending money. For demonstration purposes, I've come up with a 10-year financial forecast for NIO. And the 5-year part of the forecast estimates that they can 6x revenue in 5 years, aligned with the EV sales target of China. They currently hold 3% market share, and with the EV environment hotting up, I don't see them taking much bigger share of that market until later down the line. So that financial output that we get is around $7.2 billion of revenue, but we're there or thereabouts with 7.5. But from 2025 onwards, the model estimates NIO will continue to grow at a rapid pace, maybe by stealing market share and the EV market continuing to expand, as it probably will. And this makes for a near 40% compound annual growth rate over the 10-year period, which is just an astounding growth rate, to be honest with you, which almost no company has managed to do ever. And to put that into perspective, not even Amazon managed that rate of growth for that long period of time. We will be assuming at some point they can reach profitability, and I've put in, just to be bullish, again for demonstration purposes, that they will reach a 10% operating margin at some point in the future, which is good for any auto company. They probably could do it with the outsourcing aspects that they have, but I don't hold much hope. I mean, the gross profit margin isn't even positive at the moment, meaning their cost of revenue far exceeds their actual revenue. Then we will be averaging a terminal value, which is going to be an EV to sales and an EV to EBIT. And you can see the numbers there already. I'll show you the multiples in a moment. But we will be discounting these terminal values back to the present day based off of this bullish forecast. I won't be using the stream of cash flows as a measure of present value or intrinsic value, if you like, because one, we're not looking at free cash flow because we just don't have the right metrics for it, and two, it would probably come out negative anyway just because there is no visibility as far as what I can see as to when they will be free cash flow positive or even gross profit positive. So I'm just going to be leaving it out, and we're just going to be looking at if we could sell it on in 10 years after acquiring the business, what is the present value of that today. You can see here I've gone with 100 times EV to EBIT multiple, which is extremely high, and an EV sales multiple of 15 times, which is extremely high in my opinion as well. It's around the same as Tesla's valuation before it popped very recently. So I think that's a good cap to be using, as the likelihood is EV stocks will not be selling anywhere near the multiples they are today in 10 years, as they would have matured by then, and there will also be a lot more companies available to the market in the EV space. Just some other things as well. I have put an increase in shares outstanding of around 2.5%, just because of that dilution that is bound to come, even from the 1 billion that was invested in the company very recently from the government. There is signs that there is going to be an increase in shares outstanding. I think 2.5% is actually lowballing it a little bit, but I've put that in there. Cash growth at 5% as well, and then debt growing at nothing, which, if they can do that, that would be fantastic. And based off of those multiples, we average them out. We get an enterprise value of 340 billion or a market cap of 344 billion in 2030, or an estimate share price of $250 per share. And that gives us a value today for NIO stock of $49 per share based off a 15% required rate of return, which is my required rate of return. But for a stock like this, with the risk involved and the bullishness baked in to the forecast, you would want a 15% discount rate, let me just assure you. Unfortunately, that is 21% less than the current price, meaning even if you are very bullish to at least some form of rationality like I have done here, this stock is very much overpriced. However, there obviously are catalysts that could spur NIO even further and make the growth even better, but they seem unlikely, or at least not clear enough to account for in a valuation. As we've covered in other videos, investing is really a game of odds, and when the odds are against you, it's better to just not get involved, because the likelihood is, on average, that you will lose. Like I said, this is a bullish valuation model in my opinion. The worst case here would actually be that they never end up turning a profit, which, if you take the CEO's track record, wouldn't be too much of a surprise. I'm not saying that will happen. It is likely it won't happen, but it is a possibility that we need to factor in. Now, the bankruptcy concerns seem fairly small, as China has shown it will bail out NIO in exchange for interest in the company. So as long as that company still has value, the risk for us non-China investors is not so much our investment going to zero, but there being so much dilution and other headwinds that the positives that this company possesses, and they have a lot, get outweighed by the cons, and you end up with a poor investment return over the medium to long-term period, as this DCF suggests here. Of course, these are all just my opinions. I'm human and can be wrong on occasion, so do your own research. And my hope is that you can use this video as a piece of research and make your own decision on investing. Thank you all for watching. I hope you enjoyed the video. If you did, leave a thumbs up and subscribe to the channel if you haven't already. I'll see you in the next video. Good luck with all your investments.